Okay, very good morning, Wednesday 13th of June. Hope you're well and just getting straight into things. Talking about, well, really a few subjects to cover. What happened exactly yesterday with the pound and this, what will be the second day of the hearing and votes on the EU withdrawal bill. So we'll look at that. Also going to have a look at the Fed, which of course the FOMC meeting happening later on this evening. What's the kind of baseline expectations for that? And then a few other things on kind of geopolitics, I guess, and foreign affairs, looking at North Korea and Trump. Before I really get into those news stories, though, just to kind of reiterate a point I made to some of you guys as soon as you came in. Now, one of the first things that you should do is, well, really, this process really should have begun yesterday, when you're looking ahead and thinking about what are the key events for the next day's session. So, i.e. looking at today, Wednesday, you know that the FOMC is not due until 7 o'clock for the initial announcement and then the press conference to follow at 7:30. You know that there's UK CPI coming out at 9:30. And so then when you come into market and you kind of review the overnight news, yes, there's been a little bit of weakness seen overnight in Asia equity indices. ZTE, which is kind of at the center of this China-US trade spat, has said it's going to pay off something like $1 billion penalty, which saw their shares plummet, which consequently weighed on their equity market. But if you actually look at overall global sentiment for the assets we're looking at here, things are relatively quiet. We've had a little bit of a dip in the DAX. You can see in the center left, it's broken its range that it was trading through yesterday's session. And you can see that's a quick, fast money move and initially target then the S1 before we've had a bit of a steadying in price action. In sympathy, US equity index futures just dipping slightly, and so the pivot just acting as some support as well, respectively in the S&P. But otherwise, elsewhere, things are relatively steady. The Dixie's basically flat, and cable maybe seeing some slight underperformance, which is coming near a key technical level. We'll look at that in a second. But the point being is, I want you guys to be thinking about how are you going to trade. For the stage 3 guys today, I want to see your full trade blotters at the end of the day. Every single trade you take, I want to see your notes, and I will not allow you to trade tomorrow unless you have full documentation of each trade. This is part and parcel of your process of, self-improvement, identifying where you're going right and wrong. You need to collect that type of data on yourself and your performance. Tomorrow is a big day, as well as today, because you've got the ECB, and you don't want to miss out on that event and that opportunity. So I suggest, if you haven't been doing it, so I can see a few of you have been trading already this morning, I am going to be looking thoroughly at your notes. So you've been pre-warned. Anyway, looking at the news, let's get into it and have a look. First off, you've got the North Korean and Trump meeting. And as we were kind of discussing, as we looked at in the strategy report on Monday, this is really, there's no sparks that have flown out of this meeting that you might have thought, well, two fairly volatile characters which only a few months ago were loving the kind of the Twitter fallout and just laying into each other, have now become best friends. I'm not sure if you managed to catch the video, the Hollywood short movie that Trump had made to play to Kim Jong-un. I suggest you check that out if you haven't. It's goes to show a totally different tactic to diplomacy, I guess. But the key thing here is Donald Trump has made a little bit of a kind of an olive branch, bit of a concession. And North Korean leader Kim Jong-un said Donald Trump offered to lift sanctions against his regime when they met yesterday. A claim that contrasts with the US president's rhetoric, basically talking about that the economic restrictions would remain in place. The US before were very kind of strong in their wording about a full pursuit of complete denuclearization before then looking at the sanction side, but Trump kind of saying that there might be a little bit of movement on this. And so net, if anything, I guess this is a positive outcome from this meeting, worst case being avoided. But this meeting, as we've kind of said before, was never really a big financial market consideration, because at the end of the day here, this is kind of the slow movement of these talks between these two nations for the first time coming together, and these are expected to continue, and it's about opening dialogue for future discussion rather than something immediately meaningful happening. But certainly on that side of things, it's a step in the right direction. So I'm not going to really dwell on this too much. The thing I want to have a bit of a closer look at is, let's talk about the pound, and want to have a look at Theresa. I think this is a unique photograph because it's, I'm told it's the first time she smiled in 2018. Managed to survive the Commons vote yesterday, but not without making some significant concessions. And I'm going to have a look at the situation, but then also I think a few pointers how to monitor this type of event going forward, because today is the second day of hearings in the lower house of Commons of Parliament. So pro-European Conservative rebels forced Theresa May to make dramatic concessions in the House of Commons that all but ruled out Britain crashing out of the EU without an exit deal. So you might have, if you read the Telegraph this morning, it's pretty amazing. I mean, if you read the Express or the Sun or the Mail, it's kind of the pro-Remainers of the Conservative Party being demonised is quite incredible. But it's these 15 potential Conservative rebels that have caused the kind of headache, if you like, and this is what's brought about that rebellion about these crunch votes on this flagship EU withdrawal bill, which is the key one for Theresa May. Now, Mrs May averted defeat by promising these rebels that she would put down a new amendment expected to give MPs new powers over the final stages of Brexit. The rebels want a guarantee that Parliament could stop her taking Britain out of the EU without a deal. So this is that, the counteraction to, David Davis, let's say, who often been terming the phrase of, it's fine. We'll rather have no deal than a bad deal. They're trying to get away from that. So there's been concessions, but this isn't the end of it, as I said, because as far as I'm aware, there are secondary key amendments that are going to be looked at today quite closely. So just to recap, this is the UK parliamentary website where you can see here exactly what the kind of schedule of play is. So today, not so much that PMQs are market moving, but certainly if it's quiet and you need a distraction, Prime Minister's question time, which always kicks off at midday on a Wednesday, might provide some compelling viewing for those interested in their politics. But what you can see here on this parliamentary website, and the reason why I'm bringing it to your attention, is because you can look at the full structure of the day. And so you can see here you've got PMQs, there's a 10-minute rule motion, this is kind of a side event, and then the consideration of the Lord's amendments. So this is part 2 of the withdrawal bill, of which, if you want to jot down these numbers, because if you're watching the voting, the way it's done in the UK, I think if you were an American looking at our parliament on the yay or nay out of the chambers, then these kind of primate noises that are made by the backbenchers and so on, you're probably thinking, what on earth is going on? But the two specific number amendments that you need on your radar today is Amendment 1, which is the Customs Union, which would seek to compel the government to report to Parliament on negotiations regarding the Customs Union. So this is kind of your equal, I'd say, level of importance to the meaningful vote, which we had yesterday. And then the other one is Amendment 51, which is the EEA membership, the government to negotiate that kind of Norwegian model of a trade deal. So they're the two that I'll be looking out for. So if you remember yesterday, the first one was 110. The ones you're looking out for today is Amendment 1 and 51. If you're going to be monitoring the news. Now, the reason why this can be potentially influential is because if you look at the way cable moved yesterday, there was one quite big blip up in price action that occurred very quickly as we were going kind of through 4:30 into 5 o'clock when the real voting was getting underway. And let me just circle it here. That was that kind of pop in price action, sparked by not so much the vote in itself. This is what's key, is this is when you get the real feel and sentiment ahead of time, and information where you can obtain a bit of an edge comes from Twitter. Now, I've talked about this lady before. She is the go-to person for breaking Brexit-related news. This is Laura Kuenssberg of the BBC. And it was her, in fact, her tweet specifically that initiated the spark of activity to the pop higher in the pound. This being because her informed sources, her kind of ear to the ground, talking to the parliamentary members, was that actually enough of a concession has been made, the government will pass and avoid defeat by the skin of their teeth. The market exploded on the back of that. The actual vote then was just a matter of kind of a formality, because the market's already jumped on this already, and then we just had the kind of buy the rumour, sell the fact type price action. You can see then after these votes had passed, you know, the trade's over. We found some resistance up and around the earlier morning high, and then we've just drifted back lower again. So once again, I'd be kind of urging you guys to keep an ear on the squawk for these types of things. This is their job really to do this, but if you wanted to be proactive and monitor yourself, then this is when you utilize that tweet deck effectively to monitor these tweets surrounding Brexit, because yesterday that's what moved the market. You know, that's what traders, certainly in a proprietary trading sense, are looking at to get information fast. So timings wise, as I said, the PMQs gets underway at 12. I would say it's going to be a repeat situation. It's not set on the timing, but I would suggest probably it's going to be 4:30, 5 o'clock again when things start to pick up pace on that side of things. Sticking with the UK, there is economic data of importance coming out, and that is UK CPI. And of course, with much of the major Western central banks, this is kind of the hot area that needs monitoring in order to be really the decisive factor in the direction of monetary policy. And CPI in the UK has obviously been quite interesting, because this is what CPI has looked at after it peaked in the month of November of 2017. We hit 3.1%. We were kind of consistent for a good 6-month period with an elevated inflation level, well away from the Bank of England's target. However, since then, we've had a quite dramatic and consistent, at least, pattern of decreasing inflation numbers. 3 to 2.7, 2.5, 2.4%. And all the while, if anything, wage performance in the UK has done the inverse of this. It's started to pick up, and so we've moved back into positive real wage growth, which was obviously a negative on the consumer through much of 2017. Now, the expectation today is for 2.5%. So that is looking at a kind of stabilization then of this decrease in which what we've had, and a move back to the March print. However, if you look on your calendars, there is a significant range of market expectations. They range from the most kind of bearish, if you like, or most pessimistic on inflation continuing to fall, down at 2.2%, and the most kind of optimistic, the person who thinks inflation, actually, I'd like to know their reasons, how they've come to this this belief that it's going to jump so dramatically. But there is one research house, I'm not sure who it is, but there's one person on the street going for 3%. They're actually looking for a jump all the way back up. I think it was 3%. Yeah, 2.2 to 3%. That's a monster range for CPI. I would have it a guess that one person going for 3 or one bank would be an outlier, and they'd probably be more clustered in a realistic range of probably something like 2.4 to 2.6. But that being said, this is what you guys need to be doing this morning and planning accordingly, is what if that did materialize at a 3% print? Now, what happens then? The underlying reason I'd want to know whenever you see a statistical anomaly like that is why, and usually if it's a significant jump and an outlier, there's a one-off explainable reason why that may have occurred. And so therefore, if that makes sense, it gets discounted, and the trend is what's looked at rather than the one-off blip that might be just written off because of a one-time effect. So something to just bear in mind. That doesn't mean, though, that the market won't still see that knee-jerk reaction of sterling strength if that did materialize. It just might not be as sustained as you might think. So this is going to be key. What would 2.2% look like? Because as you can see, if we hit the lower bound, this definitely puts inflation at the lowest on this 12-month perspective. Well, stretch out the chart a little bit further to a 5-year, and 2.2 basically puts us back to where we were kind of in the mids of 2017, when it was kind of rising at that point, given the sharp depreciation of the pound post-Brexit, or post-EU referendum, I should say. So again, forward planning, one thing that's been, I think, fairly high correlation, I know some of you guys have been looking at this week, has been the inverse nature of the pound and the FTSE. Looking this morning, that's not so obvious. So one thing about correlations, I think, that can be a common trap for new traders, is that you might look at a correlation one day and it works perfectly, and so there's a tempting kind of routine that maybe you go back to it and start implementing the same view but on a different day, which carries entirely different context, and so therefore the correlation could break down substantially, or in fact have no effect at all. So really you do have to kind of look at each day objectively and then reevaluate, and if you come to the same analysis, then the same play might still be prudent. But what I'm saying is that try to treat each day in its own situation, because as we know, certainly on the fundamentals side, what happens one day can have a completely different reaction the second, once markets have repriced and traders and human participants have kind of readjusted to the new normality in that sense. Quick look at the pound, because we have edged a little lower this morning, and we're coming down to a fairly interesting support point, at least in the short term, that being the lower bound of the price action from yesterday, which in fact was the low really for the last trading week, if you're looking at the last several sessions consecutively. And so just finding a little bit of support around there at the moment, but it's going to be one that's going to be interesting to watch. The CPI, I'd say, is going to be the trigger point for whether or not that level might hold or break. As that we saw yesterday with the wage data in the UK, just be mindful of any of that pre-positioning type movements, specifically for the pound ahead of tier 1 data, that can be quite a common theme. So whether or not that's a telling sign then for the overall outcome of the number is yet to be seen, but just to be aware of the positioning that can occur. So yeah, it might be the case that that level will hold, the data will come, and if, as I say, if we get a 2.2 type print, then certainly that would be enough to trigger the break of that level. I would imagine also that S1, so then be targeting down towards the lower bound of some of the price action that was at the beginning of the month in June, as a target down toward the 133 handle under those circumstances. Okay, quick look at the other big thing for the day then. If we go ahead, as you can see here, and we'll discuss this, the UK data, just to put this into perspective, you can see here there's what, let's say 12 different pieces of economic data coming out. So that's a lot of information. The key thing to do here is assign a priority and order as to what the market will take its cue from in order to have a meaningful impact on prices. And so in this respect, even though these are all inflationary linked economic data points, it's not the PPI and the RPI that the market will be so focused on. It's going to be this CPI reading year on year is the key headline that we look at in the UK, and also the core figures. But the CPI year on year is your headline key focus, of which the initial knee-jerk reaction will be derived from. Going further into the afternoon, we start to then get the inflation data, likewise out of the US. However, this is the PPI and comes a day after the US CPI report yesterday. Well, there's a bit of a damp squib, actually, basically in line. And I think what was quite pleasing for me to see yesterday was that for the guys new to the third stage of the career program, you all remained pretty disciplined. Because what can be quite often the case is you kind of look, the market becomes fairly quiet, the market gets latched on to a certain event, i.e. a big piece of economic data. We know inflation is key for the Federal Reserve, and so therefore everyone's waiting. But then what was good is that because the data was relatively in line, there wasn't really anything to trade in that data set, and you didn't trade. Absolutely the right decision. And it's about having that control and that discipline, which is really important. And it gets hard psychologically when you wait for these big events to then do nothing, because you feel like, well, that's time that I've lost. But this is the inherent truth about trading short-term intraday markets. You've got to get used to that type of environment. Okay, otherwise, a quick look at some other things. You've got the crude oil inventory numbers coming out later. Charlie has put the numbers into the chat room, so I'll let you look at those in your own time. We'll be revisiting those numbers a bit later on. And then the other main thing I just wanted to quickly talk about is the Fed. You've got the FOMC interest rate decision. Two-part event today. So remember, there's 8 meetings of the FOMC per year, 4 of which are seen as more key than the others, because on these ones you get the summary of economic projections, with their forward-looking outlook for the employment situation, for the inflation situation, for GDP, and importantly this so-called dot plot, which is their interest rate projections over the subsequent years going forward and the long run. And that's what the market uses to gauge on how hawkish or dovish these events are. This is then followed with a press conference and a Q&A with the Fed Chair, Jerome Powell. So a quick review of this and what we're looking at. And as Bloomberg indicating, I did send this out to you this morning, the dot plots would be very telling. So let's just have a quick look at what we're suggesting here. So as a refresher, each of these specific yellow dots represents one of the Federal Reserve members. The lower they are, this is the end of this specific year of where they see interest rates at that period. The higher, hawkish, the lower, dovish, and then the years going out, 19, 20, and the longer run. So you can see here, the median connection of dot plots sees interest rates rising over the next 2 years before then tailing off into the longer run. That's the cycle of which the market is, or the Fed have communicated. However, this is where federal funds futures belief is, and this has always been the case because of, I guess, some question marks certainly through 2016 about Fed credibility of what they say and what they deliver. The market does have a tendency to sit on a more dovishly priced curve than that of actual Fed projections. The key is really not so much these latter ones, of which definitely will need to be watched. The key today is going to be this one on the left, 2018. It's going to take, in fact, only one member to move that can entirely shift the composition of how many rate hikes are expected for this year. So the FOMC was fairly evenly split in March, and you remember they're currently on track for 3 rate hikes, of which today would be the second. Remember, today's rate hike is absolutely a non-event. They're doing it. I can pretty much guarantee it. I'll put my house on it. They're going to hike rates. You can hold me to it. That's how confident I am. That's not what's important. what's important is the following communication about what are they going to do thereafter. That's what's going to be key for market reaction. Just one participant, one of these dots, switching to 4 hikes could shift the median of the committee, and so that's what's going to be key. Does that materialize? Accelerating growth and inflation rising to target obviously support the argument for more aggressive tightening and would be supportive of a more hawkish argument. However, wages have been fairly lackluster. There's been fragility in the emerging markets that we've seen in the likes of Turkey, which carries some potential tail risk of contagion effects. And then obviously there's this trade war ongoing with the threat of it escalating, which would be destabilizing then for forward economic growth in the country. So this is the balancing act. But it's the decisions here, the language that's used, but the dot plots are going to be statistically very telling of what they're going to do. And this will be then conveyed in the press conference to see how Jerome Powell then follows that up. All right, I'm not going to talk about that anymore because we're going to go into it in a lot more detail later this afternoon. My kind of final wrap up then and kind of, I guess, guidance for today is just be realistic. You know, you've got the data coming out at 9:30. Cable's obviously sitting in a nice level at the moment of support. Think about it now. How would you play it under both scenarios? If it was high, an outlying high number, or low, how are you going to execute? Not just about entry, about exit and appropriately managing that risk. And then what quite often happens is if the market is quiet, as it probably likely will be in the latter part of the day, sterling could be interesting, but everything else could be quiet as the market awaits the FOMC. No bigger institutional flow is going to hit the market ahead of that event. And so, you know, just be prepared that potentially being a little bit more conservative might be the better option, unless, of course, something unexpected occurs. Finally, just having a look at oil prices here. I've just seen them shoot up a little bit since I've been speaking. Let's put it on a minute. That's a minute on oil. So it's just popped 25 cents. The IEA says Iran, Venezuela oil output could slump by almost 30%. So that's a headline just come out. That's your catalyst for that last little pop that you've just seen. So that figure, I guess, being a slightly larger figure than most people were expecting in terms of the cumulative value of how much it was going to fall under those two political and sanctioning sides of the story. So just had a bit of a pop. Also, Kremlin says Putin does not plan to discuss exit from global oil output cut deal with the Saudi Crown Prince. So a couple of comments just hitting the tape at the moment, worth keeping an eye on for oil. What's been interesting with oil, from a technical point of view, you know, this is the chart we were looking at in the strategy report on Monday, and so far it's continued to kind of, you know, play within that range that we were kind of suggesting, given the violent movements that were seen at the end of May, just 2 weeks ago. The market seems to be consolidating and waiting for that major event, but is sensitive, as you can see, in the short term. So the ebb and flow of the conversation and what are they going to do on that June 22nd meeting. So this type of price movement, these little flashes of activity, will become more common, just given the historical precedence of these OPEC, non-OPEC members making comments well ahead of the actual meeting in itself. All right, that's it. Have yourself a good day, and I'll catch you in the chat room.